Once again, I'm Dr. Yemisi Adeyeye. I am the MD of Lifehound Hospital and I'm a business management consultant. I run Yemisi Adeyeye Consults, and this is an amazing program where I teach you different things about businesses. It's basically an ad-holding course, and today we're going into the financial aspect of our businesses. We'll be talking about bookkeeping, about classification of accounts, and also taxes. These are very, very vital to our business growth. And I hope you have your writing materials, your journals to take notes, because when you know these things, nobody will be able to cheat you. You'll also be able to give direction to those who will work with you, help you in the area of your accounting and bookkeeping. So I just want to run through different courses that are under this mentorship program. And we have basics of entrepreneurship, attributes of a highly successful entrepreneur, EMC Adeyeye, entrepreneurship model. That was a model I created, and of course through the help of God is inspiration. And we've taken legals. We talked about different kind of business registrations, and we also have a topic on vision, mission, and corporate governance. Human resource management is huge, and that's one of the topics that we have in this bouquet. Um, we have marketing, 7 steps to huge sales, and brand loyalty. Everybody wants their brand to be the top brand, okay? So we have a course on that, and also customer relationship management, how to manage your customers, to make your potential customers your returning customers, and also turn them to, brand loyalists. And also we spoke about a business Canva model and our business plan. So we spoke about the last class we had sources of funding. So today we'll be speaking about basically finance, business finance, bookkeeping, accounting, taxes. So, and today I'll be bringing on board an amazing guru who will take this class. So very soon you see grace the screen. So let's get ready to learn. And it's going to be a fun time. It's not going to be difficult. So I hope that maybe by the end of this class, we'll turn all of you to accountants, chartered accountants, okay? All right. So in a time being, let's just get ready to receive our next trainer.
Good afternoon, everybody. My name is Glory. Some of the things we'll be learning are things that at some point in time you must have heard them, but then we are going to be seeing how to apply them to our businesses. Now, we are looking at bookkeeping. What ability for you to be able to record your accounts, everything that crosses your business, every transaction, you must be able to note it down. That is the practical way of saying what bookkeeping is. The ability for you to be able to track every transaction, whatsoever it is, just make sure it is noted down. As we go on in the class, you would learn more on the way you can classify whatsoever you must have recorded. So don't mind, just bookkeeping is your ability to track every transaction that you must have that passes through your business. Now, you might feel that, why do I really need to record? Is there really a need to record? At least I know what happens in my business. The truth is that, it's said that whatsoever you pen down, it's not easy to forget. But then when you don't pen things down, you might think, I will remember. When you need that information, you'll not remember again. No? You just, so what now happened? So how did it go? No. But once you've written it down, you don't have a problem. You can always fall back on whatsoever you have written. So the essence of bookkeeping is that one thing it helps you to do is to ensure proper decision making. You are able to make decision on your business holistically. Why? Because you have recorded every transaction that passed through your business. Be it I bought biscuits for every staff, you recorded it. I bought I just fixed the wardrobe and the shelf where I keep files, you record it down. We will still talk on classification, like I said. It helps you to be able to make holistic decision that, okay, at the end of this year, where did my money go the most? Where did I spend money the most? What brought me more fund? Who are the customers that patronized me more this year? It's easy for you to be able to make decisions holistically. That's why, because you've recorded every transaction that went through your business. Another thing that bookkeeping helps you to do is that it helps your budgeting. Now you can budget from, there is something that we call forecasting. I'm sure you must have heard that. And then there is something we also call the actual transaction. What budgeting helps you to do, you are able to compare previous transactions with the current transaction in the year. Now, take for example, you were not able to track the amount you spent on petrol last month. You won't be able to predict what you will spend in the coming months. But take for example, you have taken the proper record of the amount you spent on petrol. You will be able to compare. You will be able to create a budget. Okay, in the month that is to come, I am expecting to spend 25,000 on petrol. Why? Because I spent 20,000 last year, and I discovered that this year, now I'm using year, I used months earlier. This year, they've increased the price of petrol. So using the increase, I can say that I am always within the range of 20,000 last year. Now, factoring in the increase in the price of petrol, this year I should be able to spend this on petrol. Now, so it helps your budgeting. In fact, you are able to present it to people that this is what I'm expecting to have this year, and it helps your comparison. Also, it gives your business a very good outlook. Before people, you don't appear disorganized. Why? Because you can track each item that money was spent on. And I said earlier that we are going to look at classification. So our business has a very good outlook. Why? Because the business is more organized. Investors are interested. People want to invest in your business because you have a book to present. It's even more perfect if you have the ability to get an auditor who goes through that which you've recorded. Probably you got an accountant to do those day-to-day transactions for you. Once an auditor vets it, that audited account can get you loans, it can get you grants, it can get you anything. So doing the right thing, keeping record of your transaction, it takes you places you can't even think of. Places you can't think it would have taken you to. Okay, and then we look at that's that for bookkeeping. If you have any question, probably you feel that you still need more enlightenment, you can ask. We move to cash flow. Now, when we talk about cash flow, what do we mean? It's describing the movement of cash in and out of your organization. Why do you need to trap your cash flow? It prevents you from being cash trapped. Take, for example, you don't do proper cash flow analysis. Like you don't even know your liquidity level. Now, when I say liquidity level, what I mean is this: the amount of cash and cash equivalents that you have. Cash and cash equivalent can be a physical cash. It can be something that can be easily translated to cash. Now, your receivables is also a cash equivalent. Now, when you are able to track your cash inflow and cash outflow. It helps you to know, okay, what physical cash do I have, or what do I have in my organization that can be easily that can be easily made into money. Now, it prevents you from some mess that you don't want to go into. Take, for example, if you just have an imaginary view of, okay, I think I should have 50,000 naira without being sure, and you've promised somebody to come and collect 50,000, releasing a check, on getting to the bank, they said you don't have some as much as that. You know, it can be embarrassing. That is why we need to keep continuous track of the movement of finances, of cash into and out of our businesses. What it helps you to do is that it prevents us from being cash trapped. That is one of the things that cash flow helps you to do. And if you want to do your cash flow analysis, how do you do it? What you just need to do is, okay, for this month, you know the balance as the physical cash at the beginning that you have. At the beginning of the month, you add up all the inflows that you are going to be having, you subtract your outflow, then the balance you have is the cash flow that you have. Now you can make decisions on spending from that. We've spoken about the advantages of cash flow. We said it prevents you from being cash trapped. Now, one basic thing that we are going to talk about, if you have not really learned anything before now, please, it will be good for us to pay attention from this point. It's very key that we take note of this. Why? Because many business owners, especially small businesses, fall into the trap of drawings. Drawings. I'm sure you have heard before now, drawings. Now, what is drawings? In just the practical meaning, you are taking from the business what belongs to the business. Take, for example, now, you invested into the business and the business already made its own profit. Not your salary, not the salary that we'll still talk about it later. You have to pay yourself salary. I'm sure you must have heard before now. As a business owner, in order to avoid drawings, pay yourself a salary. Once you have paid yourself a salary, don't go beyond what you have allotted as a salary for yourself. Now, it is good. There is a concept in accounting that is business entity. And it says that a business is solely different from the owner. Now, you as a business owner, you are a separate entity from the business. So in order to make everything organized, don't muddle transactions. Don't bring in your personal transactions into the business. And so also, don't bring in the business activities into your personal activity. This is what I'm saying. You want to buy rice and you don't have money. And the money that is with you is the business money. You took from that, you used it to buy rice. Now, if at any cost you would have to do that, you must note it that I took drawings from the business. It must be minimal. You must avoid it. But if you don't have any other option and you have to fall back on it, ensure that it is properly recorded that you took drawings from the business. If you return it, then you will not. Please note it so that by the time you are preparing your financial statement at the end of the year, you will not have issues. we should pay ourselves salary. Another thing we must try to do is to have a separate account for your business. Don't make it to be that, sometimes I just laugh when some vendors come and then what they are bringing to present as their bank account is carrying their personal name. You are wondering that, this, from afar, you can judge the organization. So in order to, like I said earlier when I was giving the benefits of bookkeeping, I said it gives your business a very good outlook. Anybody that sees you knows that this business owner knows what he's doing. So ensure that your business has its own bank account. Everything that you need to do, I'm sure when you want to open a business bank account, you must have your CSC document, every necessary things to do. Ensure you do it. Go any length to make sure that your business has its personal bank account. Don't make it, if you've not done that before now, I think it would be a very good step to take from this moment to have a separate bank account for your business, different from your personal account. And this business account will be where every transaction of the business goes in. In fact, when you want to take drawings from that business, it's clear that this money is not my money. It's very obvious. But once both business money and your money is entering the same account, it's very difficult not to spend the business money. At some point, you don't even know when you have gone out of bound of your own personal money. You don't know when you start spending the business money. But once the account of the business is separate from your account, it makes it easier to avoid drawings. Another thing that will help you to avoid drawings, I've said two things. The first one, pay yourself a salary. The second one, make sure you have a separate business account. Now, the third thing I'm going to say is that you must ensure that you track every expense, just like we defined bookkeeping. If you are able to track every expense, you'll be able to differentiate, no, this is my personal transaction. It's not supposed to come into the business account. Once, on your way, you bought stick notes for the business. On your way, you also bought petrol. Once you are able to track each of those expenses, you're able to distinguish, no, the stick note is for the business. It should be recorded in the business. And then the petrol is my personal. I've personally fueled it. It's not the business transaction. You are able to separate. So once you are able to track each expense, it makes it easy to be able to separate between your personal expense and that of the business. And one important thing that also serves as a check for a business owner is get an accountant. Now, sometimes you feel, I don't have too much money to pay an accountant. But the truth is that if you get a very good, sometimes you can get some people who just did OND accounting and they are very good. They won't be so expensive as much as you think. And then it can move your business further than where it is currently. The truth is that when there is a third party monitoring your finance, there is a way it limits you meddling your personal transaction into the business. It's better to get an accountant who will handle the business finance and then you handle your personal finance. So these four things that we spoke about will help you avoid drawings, and it will make your account a very good one. Now, the truth is that there are so many disadvantages in not having a proper bookkeeping system. One of which is it could make you lose investors. As an investor, now I'm talking about the disadvantage of not doing your bookkeeping, disadvantages of improper bookkeeping. Now, the thing is that I, as an investor, I don't want to invest in a business that is not organized. I don't want to invest in a business that cannot tell me their financial position at the end of the year. I feel unsafe if I invest in a business that looks confused. If I invest in a business that at the end of the year, they are not sure of their financial state. So I feel if I invest in this business, what is the probability of me getting a yield, a returns from on my investment? So one of the things that's not keeping a proper to you is it makes you lose investors. Number two, it makes you look like you don't really know what you are doing. You don't even know the state of your business at the end of the year. Am I healthy? Is this business healthy? If you have a proper on this, we spent too much on this, how we can talk to this vendor, makes it easy for you to make. The thing is that if you're not owing you, you cannot follow up to the latter. Sometimes when you call some of them, you are owing me so amount, they'll say, we have paid now. The truth is, if you go and check your bank statement, or if you go and check your books, you discover that what they paid was probably is owing you 500 naira. What he paid was just 50 naira. But if you have a proper book, you'll be able to say, yes, you paid 50 naira so dates. You still have a balance of 450 that you've not paid. So you are able to track your transactions. You're able to track your debtors. Another thing that it makes you as a business owner to lose is that you lose confidence. You are not confident that this business has a going concern. You are not. What is going concern in accounting? Going concern is the concept that says that a business will continue to exist into the future, no matter how far the future is. 200 years to come, 300 years to come, this business can still continue. If you don't have a proper book, there is this fear that is in your heart. You cannot say of certainty that this business can continue. So now, that's that about that. Please, I want us to asterisk it in our notes. Drawings that we have spoken about in this last phase is very key. Do everything, every of those steps, those 4 things. That's why I highlighted them again, so that we can take note of it. It will really move our business further. Now we are going to another thing called accounting principles and standards. Now, when I just explained bookkeeping, I said that bookkeeping is the ability to ensure that you track in a practical English, track every transaction. Now, if you just track every transaction and you don't know how to track, what should I do? What should I not do? What exactly should I track? It's not just about tracking anything. What should I track? So we'll be looking at some principles, some concepts that will guide us in some of these our accounting activities. We'll be looking at accounting principles. These are the rules and regulations that guides the reporting of our financial transactions. There are rules and regulations that guides the recording of our financial transaction. Now we'll look at some concepts. We'll look at the accrual concept. This is what guides you on knowing what amount to record. If I purchase a book, every of the transactions that is going on in my business, what exactly should I note? Is it that, let me just give an example. If I purchase a generator, what amount exactly am I supposed to record? Am I just supposed to record the amount, just the figure I bought the generator, or both the amount I bought the generator and every other costs I incurred in buying it? Now, a concept called cost concept states that when you purchase an asset, you must record the actual cost you purchased it and every other attributable costs. I want to give an example. If I bought a generator for 100,000 and after purchasing it, I incurred another 10,000 to bring that generator to my office. I also incurred another 5,000 to service it, to fix it, to install it, to make sure it brings in electricity. Both the 100,000, the 10,000 I used in transporting it, and the extra 5,000 I used in installing it. All of this will constitute the cost of the generator, although the receipt wrote comes to a usable state. Now, that is the amount you record as your costs, 115,000 naira. Now, why we are doing this section is to know, okay, what amount am I supposed to record? When am I supposed to record? What shouldn't I record? That's talking about the accounting principles. They are the principles that guides what you put in your books. Now, I spoke about the cost concept already. We'll be talking about accrual concept. Now, what is accrual concept? This is what is should be used by business owners, us as business owners now. How should I know when to record an expense and when to write in something as a revenue? Now, the accrual concept states that you record a revenue once that transaction is made, not when payment has been made. Let me give an example of what I'm saying. I'll repeat myself again. Now, I purchased, I'm using sales revenue as an example. Somebody came to my office to buy kunu, but said that I will pay you for this kunu in the afternoon. I don't have the money for the kunu yet. You must note it immediately that somebody came to buy kunu. Note it. Now, we are now going to go into the classification of under your revenue, you also have your receivable. If by afternoon, he doesn't bring the money for the kunu, you now record it as I have a receivable. So every revenue must be recorded at the point where you earn it, where you earn the money, and not when you receive the physical cash. I hope we got this analysis. Every revenue must be recorded when you earn it, not only when physical cash is involved. And every expenses must be recorded as soon as they are incurred and not just when you pay it. Now, it prevents you from losing information. If you say, I don't want to record the money for this kunu now because he has not paid me, the truth is that you might never get to remember. So you must pen it down. That's at that very point when he comes to purchase the kunu, the revenue is coming. And if, for example, you bought paper and you've not paid, please record it, and then you will now go further with your classifications. That is what accrual concept is talking about. Then we have consistency concept. Consistency concept is talking about how that once I'm sure in previous classes, we have learned about policies, we have learned about rules that must be put in place in our organization. Now, rules that are put in place as pertaining your accounting system must not just be changed anyhow. Now, in accounting, we must, in our bookkeeping, our accounting transactions, you must ensure that you don't just change rules anyhow. Today, you said you are not allowing debt. You don't want anybody to owe you. And tomorrow, a friend of yours comes, you say, okay, because you are my friend, I allow you. Now, you are being inconsistent with your principles. You are being inconsistent with the rules guiding your accounting. The rules guiding your accounting says that no transactions on credit, and because somebody is your friend, you are permitting it, it is against the accounting concept, which is consistency. Now, once you have laid down a policy as a business owner and as an accountant, and probably you are doubling as both a business owner and an accountant of the business, you must ensure that once you have set a policy, I think this rule should also go in for, okay, might not really go in for human resource and all, but for your accounting, make sure that once you have established a rule, a policy, or if you are following policies set by the International Financial Reporting Standard, you stick to it. You are being consistent. You are not just changing here and there. It is very crucial. So those are some of the basic concepts that we must know. You know, earlier I spoke about business entity concepts when I was talking about drawings, that the business owner is a separate person from the business. I also spoke about cost. I said when you want to record your cost, the cost component should be all the costs, all the amounts you incurred in purchasing an item and in bringing it to a usable state. That's cost concept. I spoke about accrual concept, and I said that revenue are recorded as soon as they are earned, not just when physical cash transpires, and expenses are being incurred as at that point when you are incurring them, you are recording them. I also spoke about consistency. You don't just change your accounting policies anyhow. It will not allow the business to have stability that way. Now, another aspect of accounting we are going to look at is classification of accounts. Classification of accounts. All the things that you have recorded, as they were coming in, you were tracking them down, So after writing everything down now, how do you classify them? That's the next thing we are looking at. Now we'll look at 4 basic classifications. You classify every of those transactions into asset accounts, liability accounts, your expenses account, and your income account. I'll repeat. All of your business transactions that you have carried out in a period of time, say a month, how do I classify them? You can classify them into asset accounts, liability account, income account, and expenses account. Now, how do we know what goes into these 4 accounts? Now, before you can call something an asset, it has to be a transaction. It has to be something that you purchased for the organization that will yield returns. And you will be able to use it for more than a year, or some of it you can use it for the duration of a year. I want to repeat that explanation. Okay, I'm going to give an example. Asset accounts. Take, for example, in an organization, I bought an equipment. Okay, an equipment. Maybe I'm someone that produces chin-chin, and then I bought chin-chin cutter to be using to process my chin-chin, to cut my chin-chin. Now, that chin-chin cutter I bought, I will not classify it as an expenses. Why? Because it is a resources that I will use, and I will use it in getting money. 1, I will use it for a very long time. Take, for example, now that chin-chin cutter that I bought, I can use it for over 6 months. In fact, I can use it for over 6 years if I get a very durable one. So An asset is a resources that is within the control of an organization that provides a future economic benefits. Like that chin cutter now, the economic benefits that it is producing is that it will help me to make more profit, because with that chin cutter, I can produce more than when I'm just using knife. That is that for assets. And under assets, we have two classes of assets. We have our current assets and our non-current assets. Now, there are some of the things that we purchase for use in our organization that we use for just a short while. It's not like it's really going to stay like for 6 years. Any assets that you purchase and you use for just a period of 1 year, not beyond 1 year, such assets is to be classified under your current assets. And anything that you purchase and you would use it for more than a year, you will classify it under your non-current assets. Take for example, you purchased furniture for your organization. Furniture. Now we're going to look at our liability account. Liability account. Now, what do you are talking about? Liability accounts. That's what we're going to talk about next. Now, liability. This is the record you make when you are owing people, or yes, that is the right just practical English to use. When, okay, for example, you purchase something and you do not pay back immediately, under your account, where you should classify it is to classify it under your liability account. Now, so from this, after we are done with this section now, if you have not gotten a way to get an accountant yet, we can practicalize some of these things. You can get, after you've done all your transaction in the month, try to classify some of these things. So what you will put under your liability account is the money you are owing people. If you, for example, you bought a television for the reception in your organization and you've not made complete payment, you put it, that is, you put it as payable. Payable. If you are going to pay anytime soon, you put it is a now we have current liability also and non-current liability. The same way we classified our assets. Anything you cannot pay, take for example, you got a loan that is going to cover a period of 4 years. Now that loan is a non-current liability. It is going to span beyond a year. But if it's something, just a short-term loan, you're going to repay back in the next 4 months, in the next 2 months. It's a short term, so it's going to be under your current liability as payable. So liability is the amount you are owing people. Now we are going to go into expense and income account. Now this is what you will need for your frequent transaction. Take for example, now we are still going to talk about our petty cash account. We're going to talk about our petty cash account, but before we get there, now your expenses account, that is the book that records everything that you spend money on recurrently. Let me repeat myself. Everything that you spend money on recurrently. Take for example, you purchase, like somebody asked the question earlier and spoke about subscription. Like I said, I hope the person was talking about data. Now something like data now is an expenses. Why? Because in fact, in the next few days, you might have subscribed. Maybe if you subscribe today, now in the next 2 days again, you subscribe again. Now something that you do recurring, an expense that you incur recurrently is an example of something you can record under your expense account. And we have things that we should put in our income account. What should enter your income account are the activities that gets you money into your business. Now, that thing that you do daily that brings in money into your business are revenue. Okay, take for example, in our organization, hospital business. Now, when we treat patients, we get in money. We record it under our income account. It's the activity that we do that brings in money into our business. So such transaction we record into our income account. Okay, that's that about the 4 major classifications that we have under our accounting. Now, but there is one very key thing. You know, earlier I spoke about drawings that we should asterisk it. This is another place where I want us to pay rapt attention. It's called petty cash accounting. Petty cash accounting. That is another place where it makes a whole lot of things in cash account. Now, this is the account, petty cash account. And I was talking about how that your petty cash account is that account where you record those small items that you incur frequently. Take for example, you are always purchasing pen in your organization. Maybe you do a lot of calculation, or okay, let me use a school for an example. You know, their teachers always have need for pen, and as a business owner, as a proprietor, you are the one that make the purchase. Now, it's not every time they want to buy pen, they will come and meet you as the CEO, as the business owner, that we want to buy pen, disburse money for us to buy pen. We want to buy water in the water dispenser. Those petty little things, they are supposed to be off your neck. These are supposed to be the responsibility of the cashier. What your own responsibility should be as the business owner is ensure there is a running system called petty cash accounting and an impressed system where, one, you release a float for them to do those petty expense. They don't always have to come and meet you all the time when they want to buy water into the water dispensing machine. They don't always have to come and meet you when they want to purchase biro, they want to purchase pen. All those little things, you can always ensure there is a running system called the petty cash accounting system, whereby you release a float. Float is the amount of money that you release to your petty cashier at a period of time. Okay, let me give a practical example. At the beginning of January, you can release 20,000 naira as float to be used for the running of petty transactions that do not really need there are some transactions that don't really need your interference at all. Like I've given examples of, you want to buy pen, you want to buy water, they want to fix just a little electrical issue that just happened. They don't really have to call you all the time. All you need to do is release a sum of money, which we call float. Float is the sum of money that you release frequently for running petty transactions. Now, from that 20,000 that you've given them, they can use it in purchasing those petty items like my biro, water, fixing electricity, fixing this, fixing that. They don't always have to come and meet you. But it's not to mean that you will not always monitor the money you have released. Now, the beginning of issue in an organization or in an accounting system is lack of control. When there is no control over a system, there is an issue. So one of the key things you must take note of in petty cash accounting is that aspect of control. When you disburse money, you must ensure that you get feedback on how the float was spent before you release the next float. Take, for example, you released 20,000 at the beginning of January. You must, by the time the petty cashier is coming back, they must be able to tell you how the 20,000 was spent. They must be able to give a concrete explanation. Okay, this month we spent 15,000 naira. Take, for example, now on just stationery. You must ask questions. How come on just stationaries you spent 15,000 naira? For what? What happened? You know, once your employees know that you have control over them, although you have given them the right to buy whatever they want to buy with the petty with the float you've given them. Once they know that you are controlling it, you can monitor it, you know, they know how to manage. Now, our petty cash, don't just dump money, share, ensure that you very do frequent control. And then I said before, now if you've not had a petty cash system, make sure that you take the petty transaction off your head. You can get, okay, if you have one of your staff that you know is accounting inclined to some point, get such a person, frequently give floats, then monitor the way it is being spent, so that you can have your mind can be free to think about some other holistic transactions in the organization. Okay, I think at this point I'm going to call Dr. Yemisi Adeyeye.
It just depends on where we are talking. So now that your business house that you just opened, so you should not be the one giving them money to buy pen, money to buy crayon, money to buy, maybe you buy tape measurement or ruler or something. Don't do that again. After this class, do not do that again. So choose, if you don't have a proper organogram or where your staff, they have different things they do. So today, choose somebody who is going to be in charge of the petty cash. You know, I'm a very practical business teacher, okay? So from after this class, choose somebody that will be in charge of the petty cash. Of course, you choose someone that you can trust with money, someone that is loyal, someone that will give you feedback. Okay, so you just choose. Look at your business. What do you buy so frequently? Oh, in my business, we still buy fuel, maybe 500 naira fuel per day or 1,000 in a day or something. You shouldn't be the one. Every time they want to buy fuel, they should not be coming to you want to buy fuel. It should be that person they will go to. It should be that person they will go to. So you can give the person maybe 5,000 naira. I'm just saying, depending on the size of your transaction, what you do in your business, okay? Like my business, my petty cash is not, my float is not 5,000, it's more, way more than that. So look at your own business. What is the thing that they always buy so often, okay? So give them somebody an amount of money and let the person have a journal, or you can use an online, maybe an app or something to track it. But most importantly, the person should have a journal where we say that, okay, on so day he receives so amount of money. So when they collect from him, when other staff need those petty cash, okay, that's why they call it petty cash. They should go to her and say, okay, we want to buy petrol. So the person will release the 1,000 naira. And write it there. And you tell the person, when you have expenses that is more than maybe 2,000 naira at once, let me know. Okay, so it's not all things you buy that go through petty cash. So we are not saying you should not be the one releasing. Okay, so it should be that it's not you, they will come and ask you for every damn simple little thing. It's going to weigh you out. It's going to stress you out. It will not give you room to think about bigger things about your business. And you know, in 2021, and even in years ahead, we made up our mind to be big. So we are saying this is the way to become big. Don't attend to every damn tiny little petty thing. So let petty cash handle that. So you can have a law that said, okay, anytime you want to buy anything that is beyond this amount, talk to me about it. But anything less than this, take it to petty cash, okay? And the person in charge of petty cash must record everything. Also, anytime he gives money to anybody, the person must also indicate that they collected money from her. So, we want to buy maybe stapler. We need stapler and it's 300 naira. So the person that she's giving the money to must also indicate. There's something called source documents. Accounting is like a whole big something. It's so big. So, but we'll just keep doing this. So we're not going to give up, okay? We're not going to give up. We'll just keep doing what we're doing. But just know that for your accounting, okay? So when you give the person, let's assume this is your journal. So I'm not saying that there are other things, apps you can use. But for people who are still on a very small level, you may not have all these soft applications that you can use. You can still use your book for petty cash, since it's still very small, okay, for small business. But if it's bigger than that, you need something more than just a book, okay? So let's assume you don't have the book. So the person collecting money from this person who is in charge of petty cash must also indicate that she collected money. So let it not be that person in charge of petty cash will now say, okay, somebody, I gave all of them, I gave this person money. No. You should also see evidence that the person collected money from, from him or her. So you also let them know when this petty cash I give you is going down to a particular amount, then let me know. So when they let you know, oh, the 20,000 naira you gave us, we spent it, we have about 5,000 naira left. We just want you to know that it's about 5,000 naira left. You now know that it's almost time for you to add to the money they have with them. So someone asks that question, okay? So it's okay, you can add to it. But before you add to it, ask them for a breakdown of what they spent on. So they will not let you know, oh, we spent so amount on fuel, we spent so amount on buying maybe stapler, we spent so amount of buying paper. They would have grouped it together that way. You will see the breakdown. You can now say, oh, last 2 weeks ago, we spent only 10,000 naira on fuel. Why are you spending 15,000 naira on fuel in the same amount of time? That's when you become a CEO. When you can correctly look at what is happening and give the right direction. You ask the right question. But when you are the one, they want to buy pen, they will come to you. They want to buy chalk, they will come to you. They want to buy anything, they will come to you. It's going to weigh you out. You will not have room to think big about your business. So this mentorship platform program is for you to be able to free yourself from all this entanglement and think big.